Day, like Bloomberg.
It wouldn't be the first time the ECB has hiked into some trouble. 2008, 2011, will it be a three-peat? We got 50 basis points just 15 minutes ago. 15 minutes ahead, we've got President Lagarde. Equity futures down 0.6% on the S&P. On the Nasdaq 100, we're down 0.25%. There's the opening bow. Switch up the board and get to the bond market. Yields look a little something like this. Down 5 on a 10-year, 340 on a 2-year. Trading like a penny stock for the last week or so. Your 2-year yield all over the place. Up, down, 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 up, and now up 2 basis points. 239 on a German 2-year. Over in the United States in the Treasury market, we're higher this morning by a couple of basis points as well. On a 2-year, we're back to about 388, almost unchanged now in the Treasury market. Elsewhere in the FX market, euro dollar 105.78, unchanged there as well. Reclaimed 106 very briefly going into the ECB, and crude again. Look at this in the 60s, 66.70 on WTI. We're down by 1.3% on WTI crude. We're about 40 seconds into the session. We open lower by 0.5% on the S&P. On the Nasdaq, down 1/3%. All over the banks now for a week. The turmoil continues as Credit Suisse plots its next steps. Looking in the United States, we need to talk about Republic Bank exploring its options, including a sale. The stock getting hammered by more than 30%. Kelly Lyons has more. Hey, Kaylee.
Hey, John, yeah, getting hammered once again. Remember, this is a stock that has already lost $17 billion in market value over the course of just a week. And as you said, another 30% drop this morning, which is unusual considering usually when we get reports that a company is considering a sale, the stock goes higher. It finds support on that message. That is not the case when you are a bank that has just been downgraded to junk by 2 credit agencies because of concern about deposit outflows, and you have this mark-to-market accounting on loans that is going to wipe out shareholder value potentially in the case of a sale. Hence the reason why First Republic is down so hard, and that's bleeding through to some of those other regionals that have been under continued pressure over the course of the last week. Right now, PacWest down about 13%, Western Alliance down by 8%. As for some of the too big to fail banks, we are seeing a little pressure there as well, though not to the same degree. The likes of JP Morgan and Bank of America each down by about 1% today, as is the S&P 500 financial sector overall, at least in the first few minutes of trading here. So once again, we find these more diversified banks a bit more insulated to the pressure we are seeing in the regional banks. And of course, First Republic, as I said, chief among those today. This is a fun chart for you, though, John. Even if this 30% drop in First Republic shares today holds, its price to book ratio will still be twice that of Credit Suisse. And I'm just going to leave it on that note, John.
We'll leave it on that point. That stock getting absolutely hammered at the opening bow by about 35%. As Katie pointed out, the team here at Bloomberg reporting just yesterday evening that they might be mulling a sale. Of course, the downgrade to junk came from the likes of S&P Global Ratings and Fitch in the last day or so as well. Looking at Credit Suisse over in Swiss trading, still higher by more than 20%. The news, 1:45 a.m. Zurich time overnight. The SMB providing 50 billion Swiss francs. That's the announcement from Credit Suisse overnight. 50 billion Swiss. There's your central bank aid. Marion Hoftemeyer joins us now from Zurich. She's been up for the last 2 days or so. Marion, is that sufficient?
That is the big question, and that's what we're trying to assess today, is whether it's sufficient. The bank says it is sufficient. They didn't feel like they even needed it to begin with, but it was a reaction to just the sell down we saw yesterday and the absolute chaos and panic across markets for everything Credit Suisse. So that's the hope, is that this and their bond buyback will sort of put a floor on that and act as a circuit breaker in a sense, to get things back on track and get things more stable for them to actually complete a restructuring that they're in the process of doing.
Marion, we know that they wanted a public statement, a statement of support from the regulator, from the Swiss National Bank. They got one yesterday afternoon. Clearly they've tapped some of the aid, the liquidity provided from the central bank too. We reported, Marion, yesterday that another option beyond just a public statement and doing exactly this, other ideas include a separation of the Swiss unit, a tie-up with UBS. How seriously are those things being taken this morning in Switzerland?
They are still top of mind. I mean, the situation is not completely resolved. It will play out in the next couple of days because one of the key things here is that, yes, they have liquidity and they have capital. However, the headlines and the amount of just panic that happened will have eventually, potentially, an impact on business. So what we'll be watching in the next couple of days is just how much business has been impacted from the sense of, are clients panicking and stopping doing business with Credit Suisse? Have there been another massive outflows from wealthy clients? And what does that mean for the whole turnaround plan? If some of that starts to jeopardize the turnaround plan, we might have to see some of these other options come back to the table of, do we split out the Swiss bank? Do we force a merger with UBS? What are the other options in order to really solve for the situation?
Marion, thank you. Credit Suisse right now up 23%, though still in and around 2 Swiss francs a share, which is hardly ideal for that company right now. There is a turnaround in the German bond market. Yields were higher at the front end of the curve. They're now lower by a couple of basis points, 235, 236-ish at the front end of the German curve. Bear this in mind. The high of the year, in fact the multi-year high for the front end of the curve, has been through 300 basis points. It was only last week, I think, we saw 338 on a German 2-year, and that wasn't just about the 50 basis points people expected today. It was the 50 maybe after that, and if you pay any attention to the Austrian central bank governor, it was the 50 after that and the 50 after that, and clearly it's a clean slate now for the European Central Bank and the Governing Council. Data dependence going forward, and I wonder how much of a data point Credit Suisse will be for that ECB. Back with us, Alessio De Longis, Ella Hodja, Jay Poloski. Ella Hodja, Bob Michael, JP Morgan, this program 24 hours ago, in a seat just over there in the studio, turned around and said this was the tip of the iceberg, that this could get a whole lot worse. Do you agree?
Hi. I wasn't sure if that question was to me. Yeah, I mean, I think we've had a series now of problems, and a majority of problems actually began since last year. It's probably the most aggressive repricing of monetary policy globally that we've had, certainly since the 1980s. So it's a pretty aggressive move. So very much a boom-bust type of cycle. So hot inflation followed by very steep rate increases. You were going. And so we've seen that happen. Very difficult to say here how that pans out, right? But as we were saying earlier, the market is in this seek and destroy mode. So it will be seeking those weak links, whether it's smaller banks or less capitalized banks or potentially insurers that may have liability mismatches, et cetera, et cetera. So the problem is in the pipeline. However, we have to take a step back and realize that there is very little appetite for systemic risk from the central banks. And you saw that with the Fed intervention last weekend. You saw it overnight with the S&P intervention. So we do potentially need more acute pressure points to increase the amount of intervention, but we have begun that process already. And I think that's what the bond markets are responding to. So potentially easing of policy down the road.
We hear defense on programs like this a lot at the moment in an environment like this one. Defense, and when I ask what defense is, I'll be told high quality assets, investment grade credit. Now, Alessio, you like IG. The problem is with IG that I have at the moment is that someone might have said that to me a week ago, and SVB was IG. Alessio, can you walk me through what you actually like in investment grade?
As an asset allocator, we focus on the broader asset classes, and we really focus on duration targets, credit targets. Diversification is the name of the game in asset allocation. You delegate the security selection to the experts. So why do we like IG? At 5-6, and anytime you get an opportunity to lock in 5-6% yields between the government bond component and the credit spread on top of it, we're talking about yields that we haven't seen since 2007, and we've been starving for yield for that long. IG offers today, and maybe the lower quality IG, if you want to push the risk frontier a little bit more, offers potentially mid to high single-digit returns, equity-like returns with much lower volatility. So again, in an asset allocation context, you want to have a exposure to many asset classes, but quality investment grade, especially versus its recent history, represents a unique opportunity at this stage in the cycle. Look at the price action. It's not systemic, but markets have reacted with a marginal defensive tilt to the announcement.
Ella, can you say the same thing?
Well, I don't know. I'm a bond girl, I suppose, but we start with the central banks. And, when you have curves starting to re-steepen, so bull steepen, after protracted inversions of the types of inversion we've had in the U.S. market, for example, until now, it tells you a recession is imminent, right? And credit doesn't perform well going into that. And so for us, actually, U.S. investment grade credit is an underweight. So in the total return portfolios is actually an outright short. So we would probably have a different perspective to that. We want to be closer to home, closer to core duration. Perhaps in European investment grade credit there might be some spots of interest, but broadly speaking we are very, very conservative here.
Jay, I promise you the time to talk about it. You're not conservative, you're constructive still. Let's talk about the opportunities that you see right now. Where are they?
Yeah, John, I think we've sped up or accelerated the end of the Fed rate tightening cycle. I think that means that the dollar strength that is the big worry is not going to manifest. We expect continued dollar weakness. I think that suggests that the opportunity set really is outside the United States. As you know, you and I have been talking about for probably well over a year at this point at least. And therefore, that's where we see the opportunity set. So we're a global multi-asset at TPW Advisory, and we're significantly underweight fixed income. We're overweight equities and overweight commodities. We like Europe, strongest region in the world, Japan, a quiet winter, China, growth recovery, and Mexico, supply chain reshaping winter. We think there are opportunities in the tech sector, particularly around robotics and semiconductors. A recession, John. I've been saying that for 6 months. We're not going to have one.
You think we're not going to have one? Let's work through this. Dan Iverson, PIMCO. Let me just get through it, Jay. Dan Iverson, PIMCO, turned around and said multi-month process. Wait and see. Bob Michael, JP Morgan Asset Management. He said, regardless of what you think these central banks are going to do, financial conditions will tighten, lending standards will tighten. What would you say back to that?
Yeah, I touched on it earlier, John. Goldman put a circle around the effect of the credit, limiting credit at 0.3% of GDP for Q4. All right, so that's fine. I'll accept that for a Fed that is not going to tighten to get inflation down to 2%. That to me is the real key. The debate has been over, does the Fed have to tighten to get inflation down to 2%? The action over the last week tells us there's no way they can do that because already the zero interest rate policy winners are cracking at inflation at still 5%. We're going to work inflation down to 3%, and that's going to be an undeclared victory, in my opinion. The rest of the world, John, is accelerating. China, the second biggest economy in the world, is going to grow 6% this year versus 3% last year. So I don't see any major imbalance in the U.S. to cause a recession. Consumer fine, corporate's fine, and notwithstanding the last week banking sector fine, very heavily reserved, tons of cash on hand. So yes, tempest in a teapot here over the last week or so. Looking out 3 to 6 months, I think we're going to be materially higher, particularly outside the U.S., looking for 10 to 20% total return in U.S. dollars from non-U.S. equity this year.
Wow. Jay, I always feel like I walk away from a conversation with you thinking that's a trade for the brave. Jay Poloski, Alessio De Longis, Ella Hodger, to the three of you. Thank you, mate.
Including stupid, but brave is, I'll take brave.
Thank you, sir, as always. Jay's not alone, let's be clear. Neil Dutter of Renmac earlier this morning was talking about the US economy. He said Atlanta Now GDP tracker, something like a 3 handle, said look at where inflation is. That's a high nominal GDP world. And one thing that Neil almost does every single day at the moment is say look at the home builders. Jay said it just moments ago. The home builders in America right now, even with all this as your backdrop, the home builders in America up 0.9% on the S&P. I just want to squeeze in what's happening elsewhere and get some bank names with Katie Lyons down in DC. Katie, some big moves.
Some big moves and some more volatility halts. Both First Republic and Western Alliance were halted for volatility. They have resumed trading once again. Right now, First Republic down about 30% after Bloomberg reported it's exploring options, including potentially a sale, and Western Alliance down about 13% after being placed on watch negative by Fitch. Remember, First Republic already downgraded by both Fitch and S&P ratings to junk yesterday. We're on watch negative for Western Alliance. Both of these regional banks under immense pressure once again in today's session, John.
Kelly, thanks for that. We're waiting for President Lagarde. That news conference is going to begin very, very shortly. They had a 50 basis point hike about 30 minutes ago. You can see, I think, the VP and the President there, Vice President Luis de Guindos alongside President Christine Lagarde of the ECB. A 50 basis point hike from the European Central Bank, widely expected for the last month. Communication from the ECB week on week, for weeks now, has almost pre-committed to the 50 basis points they ultimately delivered. But there was a feeling that the last week changed everything for this central bank. The tension with Credit Suisse, the bank failures in the United States. Had we finally reached the point where things were breaking? Mike Wilson of Morgan Stanley put it well to start the week. The long and variable lags are here. Ask the question, is it time to pause? This ECB's gone 50, is it time to pause? I don't think they can offer us any guidance on rates whatsoever. They did offer us some projections, and I'm not sure what they're worth either. So 50 basis points from the ECB. The market looks a little like something like this going into the news conference. Euro dollar 105.92, positive of about 0.1%. Looking at the bond market over in Germany, we've seen a real repricing at the front end of the yield curve. Yields are higher going into this one by about 3 or 4 basis points on a German 2-year, 2.41. So what's next from this European Central Bank? Facing down tensions in the banking system, can they isolate those tensions and focus on elevated inflation and really focus on getting rates up and CPI down against the backdrop of real tension in the financial sector? And is this a template for what we can expect from the Fed next week? Here's the ECB President Christine Lagarde kicking off this news conference after a 50 basis point hike in the face to tension worldwide and going into Chair Powell next week at the Federal Reserve. What a difficult moment to be a policymaker, and as we said repeatedly, truly stuck between a rock and a hard place.
So good afternoon. The Vice President and I welcome you to our press conference. Inflation is projected to remain too high for too long. Therefore, the Governing Council today decided to increase the 3 key ECB interest rates by 50 basis points, in line with our determination to ensure the timely return of inflation to our 2% medium-term target. The elevated level of uncertainty reinforces the importance of a data-dependent approach to our policy rate decisions, which will be determined by our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are monitoring current market tensions closely and stand ready to respond as necessary to preserve price stability and financial stability in the euro area. The euro area banking sector is resilient with strong capital and liquidity positions. In any case, our policy toolkit is fully equipped to provide liquidity support to the euro area financial system if needed, and to preserve the smooth transmission of monetary policy. The new ECB staff macroeconomic projections were finalized in early March, before the recent emergence of financial market tensions. As such, these tensions imply additional uncertainty around the baseline assessments of inflation and growth. Prior to these latest developments, the baseline path for headline inflation had already been revised down, mainly owing to a smaller contribution from energy prices than previously expected. ECB staff now sees inflation averaging 5.3% in 23, 2.9% in 24, and 2.1% in 25. At the same time, underlying price pressures remain strong. Inflation, excluding energy and food, continued to increase in February, and ECB staff expects it to average 4.6% in 23, which is higher than foreseen in the December projections. Subsequently, it is projected to come down to 2.5% in 24 and 2.2% in 25, as the upward pressures from past supply shocks and the reopening of the economy fade out, and as tighter monetary policy increasingly dampens demand. The baseline projections for growth in 23 have been revised up to an average of 1% as a result of both the decline in energy prices and the economy's greater resilience to the challenging international environment. ECB staff then expect growth to pick up further to 1.6% in both 24 and 25, underpinned by a robust labour market, improving confidence, and a recovery in real incomes. At the same time, the pickup in growth in 24 and 25 is weaker than projected in December, owing to the tightening of monetary policy. The decisions taken today are set out in a press release that is available on our website. I will now outline in more details how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. Turning to the economic activity first. The euro area economy stagnated in the fourth quarter of 22, thus avoiding the previously expected contraction. However, private domestic demand fell sharply. High inflation, prevailing uncertainties and tighter financing conditions dented private consumption and investment, which fell by 0.9% and 3.6% respectively. Under the baseline, the economy looks set to recover over the coming quarters. Industrial production should pick up as supply conditions improve further, confidence continues to recover, and firms work off large order backlogs. Rising wages and falling energy prices will partly offset the loss of purchasing power that many households are experiencing as a result of high inflation. This, in turn, will support consumer spending. Moreover, the labour market remains strong, despite the weakening of economic activity. Employment grew by 0.3% in the fourth quarter of 22, and the unemployment rate stayed at its historical low of 6.6% in January 23. Government measures to shield the economy from the impact of high energy prices should be temporary, targeted, and tailored to preserving incentives to consume less energy. As energy prices fall and risks around the energy supply recede, it is important to start rolling back these measures promptly and in a concerted manner. Measures falling short of these principles are likely to drive up medium-term inflation pressures, which would call for a stronger monetary policy response. Moreover, in line with the EU's economic governance framework, and as stated in the European Commission's guidance of March 8, 23, Fiscal policies should be oriented towards making our economy more productive and gradually bringing down high public debt. Policies to enhance the euro area's supply capacity, especially in the energy sector, can help reduce price pressures in the medium term. To that end, governments should swiftly implement their investment and structural reform plans under the Next Generation EU programme. The reform of the EU's economic governance framework should be concluded rapidly. Let's look at inflation. Inflation edged down to 8.5% in February. The decline resulted from a renewed sharp drop in energy prices. By contrast, food price inflation increased further to 15%, with the past surge in the cost of energy and of other inputs for food production still feeding through to consumer prices. Moreover, underlying price pressures remain strong. Inflation excluding energy and food increased to 5.6% in February, and other indicators of underlying inflation have also stayed high. Non-energy industrial goods inflation rose to 6.8% in February, mainly reflecting the delayed effects of past supply bottlenecks and high energy prices. Services inflation, which rose to 4.8% in February, is also still being driven by the gradual pass-through of past energy cost increases, pent-up demand from the reopening of the economy, and rising wages. Wage pressures have strengthened on the back of robust labour markets and employees aiming to recoup some of the purchasing power lost owing to high inflation. Moreover, many firms were able to raise their profit margins in sectors faced with constrained supply and resurgent demand. At the same time, most measures of longer-term inflation expectations currently stand at around 2%, although they warrant continued monitoring, especially in light of recent volatility in market-based inflation expectations. Moving to the risk assessment now. Risks to the outlook for economic growth are tilted to the downside. Persistently elevated financial market tensions could tighten broader credit conditions more strongly than expected and dampen confidence. Russia's unjustified war against Ukraine and its people continues to be a significant downside risk to the economy and could again push up the cost of energy and food. There could also be an additional drag on euro area growth if the world economy weakened more sharply than expected. However, companies could adapt more quickly to the challenging international environment, and together with the fading out of the energy shock, this could support higher growth than currently expected. The upside risks to inflation include existing pipeline pressures that could still send retail prices even higher than expected in the near term. Domestic factors, such as a persistent rise in inflation expectations above our target or higher than anticipated increases in wages and profit margins, could drive inflation higher, including over the medium term. Moreover, a stronger than expected economic rebound in China could give a fresh boost to commodity prices and foreign demand. The downside risks to inflation include persistently elevated financial market tensions that could accelerate disinflation. In addition, falling energy prices could translate into reduced pressure from underlying inflation and wages. A weakening of demand, including owing to a stronger deceleration of bank credit or a stronger than projected transmission of monetary policy, would also contribute to lower price pressures than currently anticipated, especially over the medium term. So let's look at financial and market conditions. Market interest rates rose considerably in the weeks following our last meeting. but the increase has strongly reversed over recent days in a context of severe financial market tensions. Bank credit to euro area firms has become more expensive. Credit to firms has weakened further, owing to lower demand and tighter credit supply conditions. Household borrowing has become more expensive as well, especially owing to higher mortgage rates. This rise in borrowing costs and the resultant decline in demand, along with tighter credit standards, have led to a further slowdown in the growth of loans to households. And these weaker loan dynamics, money growth has slowed sharply, driven by its most liquid component. So summing up, inflation is projected to remain too high for too long. Therefore, the Governing Council today decided to increase the 3 key ECB interest rates by 50 basis points, in line with our determination to ensure the timely return of inflation to our 2% medium-term target. The elevated level of uncertainty reinforces the importance of a data-dependent approach to our policy rate decisions, which will be determined by our assessment of inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are monitoring current market tensions closely and stand ready to respond as necessary to preserve price stability and financial stability in the euro area. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. We now stand ready to take your questions.
Thank you, President Lagarde. And the first question goes to Alex Weber of Bloomberg News. Alex, please.
Thank you. Good afternoon. I was wondering, could you explain a little bit how you see the path for interest rates ahead? I mean, until a few days ago, it seemed pretty clear that interest rates would have to rise further after this meeting, but you didn't give any guidance in the statement. Does this mean it could be that we've already reached the peak in interest rates? And then secondly, regarding the banking sector more broadly, a lot of people have drawn parallels to between what happened at Credit Suisse and Silicon Valley Bank and failures we've seen at the last financial crisis like Bear Stearns. Do you see any risks that we're on the verge of a systemic crisis like in 2008?
Thank you very much for your question. On your first question, I would call your attention to one particular paragraph, which is the first one in our monetary policy statement, in which we are really trying to dissect for you the mechanism of our reaction function. And this is really the best guidance that we can provide. And it is, number one, the assessment of the inflation outlook in light of the incoming economic and financial data. Number two, the dynamics of underlying inflation. And number three, the strength of our monetary policy transmission. So that's brand new. These three components, we never discussed them, we never let them out, and they are clearly identified as the three elements that will be taken into account to determine our reaction function going forward. Second point. If our baseline was to persist, when the uncertainty reduces, we know that we have a lot more ground to cover, okay? But it's a big caveat. If our baseline was to persist, as you know, the projection that were decided by staff, sorry, not decided, but determined by staff, are based on data and assessment of the situation with a cut-off date. And that cutoff date was February 15th for the international outlook and technical assumptions, and March 1st for the euro area macroeconomic projections. Now, since March the 1st, a lot obviously has developed. And the projections that we have do not incorporate any of the most recent development, and certainly not the impact of the most recent financial tensions that we have observed on the markets. So there is a level of uncertainty that has been completely elevated as a result of that. And that is the reason why we reinforce the principle of data dependency that we have indicated in the past, with a clear map of the reaction function that we will have in the future. So it is not possible at this point in time, and on the basis of the first component that I have mentioned, which is assessment of the inflation outlook in light of the incoming economic and financial data, it is not possible to determine at this point in time, what the path will be going forward. But we know that it will be data dependent, and we know that if the baseline as we have it was confirmed and was to persist, we would have more ground to cover. On your second point, I will again read for you one more time what is in the second paragraph this time of our monetary policy statement, which is that we are monitoring current market tensions closely. We stand ready to respond as necessary to preserve price stability and financial stability in the euro area. And given the reforms that have taken place, and I was around in 2008, so I have clear recollection of what happened and what we had to do. We did reform the framework. We did agree on Basel III. We did increase the capital ratio. We did increase the financial coverage ratio as well. And I think that the banking sector is currently in a much, much stronger position than where it was back in 2008. Added to which, if it was needed, we do have the tools, we do have the facilities that are available, and we also have a toolbox that has other instruments that we always stand ready to activate if and when needed. And finally, and that's a tribute to our staff, because as you can imagine, we all have worked quite hard in the last few days, and particularly the last few hours. They have demonstrated in the past that they can also exercise creativity in very short order in case it is needed to respond to what would be a liquidity crisis if there was such a thing. But this is not what we are seeing. Thank you.
Thank you, President Lagarde. And the next question goes to, I'm now turning to remote participants, to Balazs Koranyi of Reuters. Balazs, please, over to you.
Good afternoon, and thank you for taking my questions. President Lagarde, could you unpack for me what you mean a lot more ground to cover?
Sorry, I missed the first part of your question. Balazs, can you repeat the first part? I missed it.
Yes. I said, could you please unpack for me your statement that there might be a lot more ground to cover should the baseline prevail? What does that mean? Especially given that prior to this meeting, almost all governing council members, including Philip Lane, has said that more rate hikes will likely be needed beyond March. So are you walking back on that commitment, or is the ECB's inflation fighting stamina waning? Are you giving up on inflation? The second question I have is the usual one, I'm sorry. What other options were being discussed in the meeting today? What were the alternatives that policymakers were supporting?
Thank you for your question. We are not waning on our commitment to fight inflation, and we are determined to return inflation back to 2% target in the medium term. That should not be doubted. The determination is intact, and the path at which we will cover the ground, the pace that we will take, will be entirely data dependent. That's what we have always said. And we are saying on this specific occasion that given the level of uncertainty that has been significantly increased as a result of the most recent financial tensions and developments, given that level of uncertainty, it is better to make the decision that we believe is a robust decision with our 50 basis points increase, and then see what the data tell us and what next assessment we make on the basis of that data. But let me reassure you, we are determined to fight inflation and return it to 2%. And we will take the measures that are necessary. They will be data dependent, and they will function on the basis of these three parameters that I have just mentioned to illustrate what our reaction function is. You had a second question, which you said was a repeat of previous questions, which I think had to do with any other options, what has happened behind those closed doors, and I fully appreciate the question. I have to tell you that the Executive Board proposed that option which is described in the monetary policy statement, and that no other option was proposed. I can also tell you that the decision was adopted by a very large majority, with 3 or 4 that did not support the decision, not in its principle, because they were ready to go for that decision, but they were keen to probably give a bit more time to see how the situation unfolds and what additional data we can collect. But otherwise it was a very large majority decision. And I would say taken in rather record time. Thank you.
Thank you, President Lagarde. I would like to now turn to Kolja Ruzio of the German weekly Die Zeit. Kolja, please.
I would like to ask a question concerning the data-driven decisions. Isn't there a conflict of goals between price stability and financial stability? And to what extent do you consider slowing down the pace of rate hikes because of financial stability? Do you have to slower down perhaps because of financial stability? That is my first question. And the second, were you surprised by the financial problems we see now in the US, and we saw last year in the pension funds in the UK? Was this a surprise, or is it something which was expected perhaps by monetary policy experts?
Well, let me be pretty clear on that point as well. I believe that there is no trade-off between price stability and financial stability. And I think that, if anything, with this decision, we are demonstrating this. We are addressing the price stability issue by raising interest rate by 50 basis points, which is what we had intended, and because inflation is projected to remain way above our target and for too long. And separate from that, we also are monitoring market tensions. We stand ready to provide any kind of additional facilities if needed. We do have extensive facilities, more so, by the way, than the Fed in terms of size of the collateral pools and facilities. And we can do more if necessary. We have demonstrated that in the times of PEP. All the instruments that we decided in the PEP times, whether it is on the pool of collaterals, whether it's on the haircuts, whether it's on all issues, that can be reactivated like that. And we always stand ready to use them again. So, euro liquidity is perfectly addressed. No issue on that front. So there's no trade-off. We have to do our job. This is primary objective, price stability. And as I said, in the identification of the 3 components that will inform our decision, that will determine our reaction function, you find the word financial. if you look carefully. You have assessment of the inflation outlook in light of the incoming economic and financial data. So the financial issues are captured in order to assess inflation. So there is no trade-off. We have financial stability very much as part of our radar screen and the tools that we can deploy, but there is no trade-off between the two. Did you want to add to that, Vice President?
Well, first of all, good afternoon. Well, from a financial stability standpoint, and the perspective is quite clear. If you look at the industry as a whole, as the President has indicated before, the situation of the European banks, they are resilient. Capital is much higher than it was 10, 15 years ago before the global financial crisis. The liquidity position of the European banks is robust. If you look at the liquidity ratios, on average, they are clearly above the minimum requirements and even the pre-pandemic levels. And even if you look at the composition of these liquidity buffers, they are high quality, very high liquidity assets. So in that respect, the composition is quite positive. And finally, there is something that I think that is relevant. Is the increase in interest rates, is positive in terms of the margins of the European banks. And this improvement in terms of profitability more than offsets potential losses in fixed income portfolios. Looking at the exposure, for instance, to Credit Suisse, they are quite limited. And, there is no concentration. There is no a single counterparty that concentrates a large part of that exposure. And finally, as the President has indicated, we have a toolkit of instruments just in case that are needed in order to deliver liquidity.
Thank you, Vice President. And now the next question for Martin Arnold of the Financial Times. Martin, please.
Hello, President Lagarde. Could you just explore a bit more this potential for a trade-off between financial stability and price stability? Could you foresee a situation where, given the outlook for inflation, you need to raise rates further, but there's a risk that that could trigger a financial crisis or make a financial stress worse? Second question is that given that you've said the underlying inflation is going to be one of the key factors you look at when deciding, one of the three key factors, does that mean that until you see an easing of most of the indicators of underlying inflation, which you're not seeing at the moment, you won't be able to stop raising rates? Thank you.
Thank you, Martin, for your questions, the two questions. On the first one, as I said earlier, we don't see any trade-off between price stability and financial stability. And we will address each of these two with their respective instrument. For the moment, interest rates for price stability and the set of facilities that we have available, additional lines if necessary, including in other currencies if that is needed, in order to address financial stability issues. So they inform each other. I'll come to that in a second, but we handle them separately, and there is no trade-off between the two. It's pretty obvious when I say that the inflation outlook will be assessed in light of the incoming economic and financial data, that the financial data, whatever they are, will inform our assessment of inflation. So through that assessment, those financial data, we actually take into account development in the financial markets, financing, financial cost, terms and conditions, and the financing of the economy at large. Your second question had to do, if I recall, with my second. Sorry, wait a minute. I need to get back to my second item. Yeah, because you did refer to the key, but it's the second. The first one that we mentioned is the assessment of inflation outlook in light of economic and financial data, and it needs to be confirmed by the underlying component of inflation. And on that front, we are again going to be data dependent. And it is obvious that as long as we see underlying component of inflation going up, this is not going to stop our fight against inflation. So we will need to receive confirmation on the underlying component of inflation. We will need to receive confirmation that we are heading in the direction of our target of 2%. We are seeing some slight improvement in certain areas, but frankly, not a lot. And we know that whether you look at core, which is one of the components of the underlying inflation, or whether we look at, other dissection of inflation, and in particular when we look at services, it's not yet heading in the direction that would confirm the inflation outlook that we have.
Thank you, President. And the next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Thank you for the opportunity. Good afternoon. My question
Good
is...
to see you in real life, not on screen.
Thank you. My question is on the mentioning of monetary policy transmission, which comes in your decisions in the three points that you said about explaining your reaction function. So one of them is the monetary policy transmission, and also at the end of your decisions, you mention that the Governing Council is ready to adapt and adjust your instruments to preserve also the monetary policy transmission. Mm-hmm. So we think about TPI when we hear mm-hmm. about this. Mm-hmm. I'd like to know whether you think that TPI can be used when banking tensions start to jeopardize the transmission of monetary policy, and whether in your fully equipped toolkit you could also consider to adjust the pace of the reduction of the holdings of securities under the asset purchase program, so the QT.
First of all, on monetary policy transmission, I will be giving a speech soon about monetary policy transmission and about the first leg of monetary policy transmission and the second leg of monetary policy transmission. All I can say at this point in time is that we're beginning to see transmission of our monetary policy through the credit channel. And if you look at rates, if you look at terms and conditions, if you look at the impact that it has on the demand of financing on the part of both corporates and households, we are beginning to see transmission of our monetary policy, which is really what we expected. TPI transmission policy instrument was precisely designed to make sure that monetary policy would travel and move all the way to all members of the 20 member states. To all 20 members of the euro area. And that would be caused by factors that had nothing to do with the fundamentals of an economy or its general macroeconomic policies. We have not yet had to decide whether financial tensions would qualify in that respect, but it could well be the case. I'm advancing a little bit because we did not discuss that at all, and it's something that would need to be debated with the Governing Council. Nor did we decide anything on the partial reinvestment under the APP. That's a principle that we decided back at our February meeting, which has been in place now as of the 1st of March, and that will continue to unfold in a regular and unimpeded fashion.
Thank you, Madame Lagarde. Turning back to our remote participants, I would like now to give the floor to Jean-Philippe Lacour of Agence France-Presse, AFP. Jean-Philippe, please.
Yes, now you can hear me and see me, I hope.
Yes.
Okay, good afternoon, Madame la Présidente. One question on these underlying components of inflation you mentioned. Do you put the significant contribution of profit margins into these components? Because the profit margin seems to develop well, and that could maybe put some questions on the narrative of the ECB, very focused on the risk, either on the wage price loop. And I would like to hear what you think about this contribution of corporate profits to inflation. And a second question, if I may. Mr. Guindos, you are quoted that some banks may be vulnerable. You would have told this to ministers briefed earlier this week. I don't hear this today in your statement. Maybe you can precise or confirm or not what has been reported. Thank you.
Thank you very much for your two questions. And I just want to go back to the statement. I just want to find the right sentence where for the first time actually we talk about margins. And it is, must be in the inflation sections. Anyway, I'm not going to waste your time trying to find the sentence in which we, oh, here it is. So moreover, many firms were able to raise their profit margins in sectors faced with constrained supply and resurgent demand. So we mention it very specifically. It is part of the analysis that we conduct. As has been mentioned by some of you who are following us very carefully, we had a retreat of all the governors of the Governing Council to discuss in-depth various matters, one of which was actually the various components that fuel underlying inflation, and we did have some assessment of the increase in margins by the corporates, which played a role. I'd like to say one thing, because there has also been reference to the fact that I would have mentioned the word wages X times during my last press conference. I think what we hope for is a proper burden sharing of what really is a quasi-tax. This cost push shock has been operating a bit like a tax, at least in portion of its form, and that this tax should be shared because there has to be some burden sharing. What we are concerned about is whatever the burden sharing, if that was to spiral into the second round effect that we don't want to see, frankly. But this burden sharing aspect is something that needs to be debated at society level, at corporate level, and is certainly something that we would welcome to the extent that it reduces the risk of second round effect in particular. On the other question that you asked pointedly, I also want to point to you the sentence which is in the second paragraph of the monetary policy statement, and as you know, the first paragraphs matter, and in there we say the euro area banking sector is resilient with strong capital and liquidity positions, and we stand by that statement strongly. But I will let you, Vice President, comment on this wonderful leak.
As you can imagine, I remember what I told the ministers, and it's almost identical to what I have just told you. So that the banks are resilient, high capital ratios, robust liquidity buffers, high quality of the main components of the liquidity buffer, limited exposure to the institutions of the US in that case, because it was last Tuesday of the US, and simultaneously that the overall assessment was quite clear. So that the banking industry in Europe is resilient.
Thank you, Vice President, Madam President. Next question goes to Andres Stumpf of Expansión. Andres, please.
Good afternoon, Madam President. When you talk about creativity of the staff, do you think that if needed, the ECB could come up with a tool like the one presented by the Federal Reserve, accepting bonds like at par instead of market value, or would it face legal constraints? And I have a second question, if I may. You have visited Spain recently, and I'm sure you are aware that there's a concern about the low remunerations on deposits there. Banks say that this is because they have plenty of liquidity from the ECB. So I was wondering if you think that the low deposits are going to continue until TLTROs mature, or it is something different and you are not in the same point as the banks. Thank you.
Well, thank you. Thank you for your two questions. So when I say that I have full confidence in staff creativity, what I mean is that I have seen them in action. They've been there, they've done it. And on the occasion of COVID, for instance, they were able in very short order to put together programs that proved extremely efficient in order to resist the downside effect of the crisis. So those tools exist. They are strong, they are powerful, and they can be reactivated anytime. We always stand ready to do that. Added to which the facilities that we have currently are probably broader and more accessible than the ones that pre-existed at the Fed. So I don't see the need at this point in time to explore any alternatives to the tools that we have, because I think that they function. If it was needed at some point in time, of course, I know staff will stand up to the occasion and will also look at what can be done within our mandate and in accordance with the rules of the treaty under which we are governed. On the issue of remuneration of deposits, I have spoken my mind on Spanish television. And I have observed that in quite a few countries now, the DFR is taken into account in order to determine the rate at which deposits are remunerated, either deposits at sight or term deposits. And that obviously this is something that needs to be debated between the clients and their banks. But I observe that there are quite a few countries where banks actually do that, and competition between them is facilitating that process.
Thank you, Madam Lagarde. The next question goes to Eshe Nelson of the New York Times. Eshe, please.
Hi, good afternoon.
Good afternoon.
I would like to go back to this point about the incoming economic and financial data. I mean, in the past meetings, we've heard a lot about what the economic data is, the underlying inflation data. Could you detail a little more what the financial data is that you'll be watching? And is there a new emphasis on this data, or has it always kind of been there? And then my second question is, how much has the volatility we've seen in bank stocks recently as the meeting was happening affected today's decision, not necessarily the interest rate decision, but the choice to not kind of lay the path ahead more clearly? Thank you.
I like your last word, clearly. This is something that we are longing for, clarity. Because obviously we work on the basis of data, of observations, of facts, and there is currently, for the reasons that I have mentioned in my monetary policy statement, a degree of uncertainty that pre-existed, but that has certainly been amplified by the most recent financial tensions that we have observed in the last few days. So that has, it's obviously difficult for a group of 26 members of the Governing Council to come to a decision in the face of projection and the first of the three elements that I have mentioned to determine our reaction function, to come up to a decision. But we were certainly confident that this 50 basis points rate increase was a robust decision considering the ground that needs to be covered. What financial data do we look at? We are particularly concerned, obviously, about our monetary policy transmission. So we look very carefully using various analytical tools. We look at credit. credit to corporates, credit to households, terms and conditions, restrictions eventually, if they were to be observed, to assess whether the financial conditions are tightening and what impact this tightening of financial conditions will then have on the economy. Those are the key components that we assess to determine our monetary policy transmission.
Thank you, President. And the next question, going back to our remote participant, goes to Tom Fairless of the Wall Street Journal. Tom, please. Tom, can you hear us? This does not seem to be the case. Then I would give the next question to Eric Albert of Le Monde, also connected via video call. Eric, please.
Good afternoon. Thank you very much for taking the question. There's been a lot of parallels done with 2008. Obviously, the banks are in different circumstances, but in July 2008, the ECB increased an interest rate, did an interest rate hike just 2 months before the biggest financial crash in recent history. Is the ECB at risk of doing the same mistake? First thing, and the second question is about the transmission of monetary policy. It takes a long time for interest rate hikes to go through the economy. Given the uncertainty, isn't there a case for at least slowing down? You said you were data dependent, but isn't there a case now to slow down in the next few meetings?
Thank you very much for your two questions. As you said yourself, the banks are in a completely different position from 2008. And, crises are never exactly the same anyway. But the architecture of our banking system, the framework within which they operate, the supervision that is applied to the banking system have been all considerably improved. So, obviously, we are mindful of our history and what has been done in the past, but we are all confident that the decision that we made today is a robust decision, was called for, was needed, and we have, as you have noticed, I'm sure, indicated very precisely that as to the future, we would be data dependent. And that, I think, is predicated on the fact that we need to have a better assessment once the financial tensions on the markets abate in the future. On your second question, we are seeing we're beginning to see a good transmission of our monetary policy in the credit sector, as I have mentioned earlier on. I think we have seen a reduction of several basis points, 20 to 16 basis points, depending on whether you look at corporates or households, increase in the credit rates that are offered, and a significant tightening on the part of the banks that are probably assessing and reassessing the risks that they're taking. So this is, in our view, the beginning of an indication of good transmission of monetary policy. This is not the end of it. As you said, it takes a longer time. It seems to have transmitted rather rapidly, if you consider that we decided to normalize our monetary policy back in December a year ago, so it's a little over a year ago, and we are certainly beginning to see in the credit segment the impact of our decisions. Are we seeing dampening demand? That remains to be seen, and how much more does it need to be dampened in order to meet the objectives that we have, which is 2% medium-term target, to be seen. We are data dependent. We're going to really look at the uncertainty fading out, hopefully, and what projections we will be able to operate upon, as well as what assessment we can make at our next policy meetings in May, June, and subsequently.
Thank you, Madame Lagarde. Let's try again with Tom Fairless of the Wall Street Journal. Tom, can you connect?
Hi, can you hear me?
Yes.
Okay. So thanks so much for taking my question. I I suppose the first question is, we've started to see these signs of weakness in financial markets, and you haven't taken that as a reason to pause. But is there, do you think, a message in what's happening? It's something that we haven't seen for a while, and that has reminiscent, it kind of brings back memories of maybe the financial crisis, as other people have said. I mean, is just the unusualness of this a reason to kind of think twice about future rate increases? Do you think, with this phrase that we hear, raise rates until something breaks? And my second question was related, that at the moment, the bank failures were in the US. Do you think this is more of a US-specific issue? Do you think there's something fundamentally different about Europe that means European banks are less vulnerable? Or maybe the level of your policy rate means they're less vulnerable? Thank you.
Thank you very much for your two questions. On the first question, I would like to just reiterate our confidence in our banking sector. As I said earlier on, it's a banking sector that is resilient, that has strong capital and liquidity positions. And we are monitoring the particular situation, and we are monitoring the market tensions, and we stand ready to respond with all the tools that we have that can be switched on, and by any tools that would need to be applied to the situation depending on the circumstances. So it's not business as usual, but we believe that the decision that we have taken is robust, is completely justified by the circumstances, and informed by our current analysis. Is it a US-specific problem? We are all governed by, the banking sector is governed by Basel III, and banks operate within the framework of Basel III. As you know, there have been multiple discussions and disagreement as to who applies Basel III better than the other. But I would simply observe, because comparisons are pretty odious, that in Europe, we have strong supervision, we have strong capital, and we have solid liquidity positions. And as the Vice President said, exposures are not concentrated. And based on the work that has been conducted by the SSM, we don't have similar occurrence as the one that occurred in California, for instance. But maybe, Vice President, you want to add to that?
Well, perhaps, the only thing to add is that the business model of the Silicon Valley Bank was quite unique. And that it was, there was a mismatch between the assets and the liabilities that, it made this bank vulnerable, and this has been indicated by the American authorities, to any important change in interest rates.
Thank you, Vice President. And the last question today goes to Leonidas Exousidis of Handelsblatt. Leonidas, please.
Thank you. Good afternoon. I have a question concerning the excess of liquidity and the ECB balance sheet. Did you discuss about an increase in the level of reduction? And if yes, when could this increase start? Thank you.
Thank you so much. You give me a chance to be very brief in my response. No, we did not discuss. We had plenty to discuss today, and we did not discuss that particular one. Thank you so much.
This concludes our press conference. Our next press conference is on the 4th of May. Until then, all the best and have a good afternoon.
You have been listening to ECB President, Madame Christine Lagarde, speaking at a news conference in Frankfurt. This after, Alex, the ECB delivered the much-promised 50 basis point hike. Where we go from here remains, I think, an open question. I thought she felt a little off balance compared with a more polished performance that she's delivered in the past. Inflation is projected to remain too high for too long, as a result of which we get a 50 basis point hike. But those projections do not include the current financial stress, as a result of which we now no longer have guidance working forward from here. We get an understanding of the reaction function, but very little guidance.
Yeah, it does seem like if Credit Suisse wasn't in the picture, maybe the balance would have been a little bit more concrete. Trying to walk that fine line with, yes, we were looking at financial stability, yes, we can handle it without being too definitive while trying to tackle inflation, that's an impossible tightrope to walk, and it feels like that's exactly what they had to do, especially de Guindos having to answer questions about whether or not the other parts of the economic system, financial system were in danger from Credit Suisse as well.
He talked about the fact, and she talked about the fact that the banks are much stronger than they were back in 2008. And Madame Lagarde talked about the fact there was no trade-off between financial stability and price stability. But that was a point that was pushed a great deal by those that were questioning her today. Let's talk about how the markets have reacted to what we have seen today. We did see initially some weakness in euro-dollar. The market initially, I think, taking this as a dovish hike because of the lack of guidance that was delivered. We're now trading at 105.82. The German 2-year barely changed today. And it's interesting that banks are not at the center of the story here in Europe when it comes to the sectors that are moving today, Alex. The Stoxx 600 is up by around 0.5%.
It's still definitely the story here in the U.S. Talk about the financial stability concerns not resolved no matter kind of what we hear. You're looking at the S&P pretty much flat. That's not what the story is, though. The story is First Republic, down 30%. When you put in guardrails and then the investors don't pay attention to the guardrails and the stock keeps plummeting, that's more of a significant problem. Overall, the regional bank index is off by 2%. The reason why this is also interesting is because Treasury Secretary Janet Yellen is currently talking before the Senate Finance Committee. So clearly, these regionals very much front and center. Now, in terms of the 210, some interesting dynamics here happening. You have actually a change in the curve a bit. We're now about 53 basis points on the spread. You're seeing a little bit of selling in the front end. That kind of picked up a little steam as Christine Lagarde was talking, and a touch of buying in the long end. If the ECB can go 50 and can move through, then the Fed can probably still continue to go and then move through the financial stability concerns as well.
Absolutely. What is the message out of Lagarde into Powell? Well, let's go back to Frankfurt. Maria Tadeo is covering the ECB for us today in Frankfurt. Maria, let's talk about the message that has just been delivered. The promised 50 basis points was there, but there was no forward guidance. What does that tell us about the certainty with which the ECB is now operating?
Well, look, I think she was very clear at this point. It's very hard to tell what the path forward will look like, and it will be very data dependent, as you point out, to this idea of very aggressive forward guidance. Well, that is essentially gone. We did not get any of that here. She also kept referring to this statement. To me, it was also very telling that she kept repeating and pointing to lines, very little off script from Madame Lagarde, saying a lot of the measures that will be taken forward will obviously focus on the inflation dynamics, on the core inflation, but also some of the transmission of the monetary policy and the way that feeds through. She obviously acknowledged that there had been real tensions in the banking sector, but again tried to instill some calmness, saying I was there in 2008. This is a different situation for European banks. It was also interesting, if you ask me too, when she defended this 50 basis points hike, which she had calibrated very well a month ago, essentially said the reason for it is inflation is just too high. There was a large majority for it. 3 to 4 members did not agree, not on the principle, but just on the timing. They wanted more time to digest whether or not the volatility perhaps merited a more careful approach. And then also, I guess, the line that really just sums up this press conference, she does not see a trade-off between price stability and financial stability. Whether that holds or not, I guess we'll have to wait and see.
Yeah, that's the key question, and will determine where the ECB goes from here. Maria, fantastic coverage from Frankfurt today. We always appreciate it. Thank you very much indeed, Bloomberg's Maria Tadeo. Let's talk about that press conference. Let's talk about, as Maria says, the constant referencing back to what was clearly a well-crafted statement delivered at the beginning. Here are President Christine Lagarde's remarks on why policymakers stuck with that 50 basis point hike.
Inflation is projected to remain too high for too long. Therefore, the Governing Council today decided to increase the 3 key ECB interest rates by 50 basis points, in line with our determination to ensure the timely return of inflation to our 2% medium-term target.
the president of the ECB, Christine Lagarde, speaking moments ago. Joining us now, Erik Nielsen, UniCredit Group Chief Economist. Nice to see you.
Good to be here.
You watched that. What did you think of her performance?
I think it was a good statement. It's a very difficult situation they were in. There were a lot of discussions. You saw the big movements in the price in expectation of what they would do. I think they did the only thing they could do, deliver the 50, because they had tied themselves to this silly mask of pre-announcing. And I'm very happy to hear that they don't do this anymore. So they acknowledge that there's too much uncertainty, that it took all this turmoil in the market for them to do that. And number two, spell out a little bit more clearly what the reaction function is. I think it was good news.
Erik, she really was able to, Christine Lagarde was able to hide behind the fact that sort of what they were able to consider ended on March 1st and the end of February, right? So they didn't have to take into account necessarily what's happening with Credit Suisse in the U.S. banking sector. What do you think, though, is really going on behind the scenes when they're talking here?
Well, I think they have been scared. They have obviously been looking very, very carefully at the banks. But I think everything we see in our team and people we read confirms what she says. At least among the European banks that's supervised by the ECB, we don't have problems like what you've seen in America in some banks and at Credit Suisse. So, but of course it is a brave statement to come out, a brave message, given the fact that nobody saw this in America. Well, Credit Suisse we all knew was trouble for a long time. But certainly, I mean, we had the auditors being in there 2 weeks before in America. We have had all sort of statements that in retrospect we say, how could this happen? And now you stand up in Europe and say, we don't have any of these problems. That's a brave statement, but they feel confident. So I think they did the right thing, and don't underestimate the fact that she kept saying, almost like we'll do whatever it takes, meaning we have a toolbox, we have it all ready, and we can provide liquidity if we need to. So I think that was good, but they must be a little bit more nervous than they came across as.
She seemed to imply that the circles of the Venn diagram, financial stability, what they do on monetary policy, don't overlap.
Yeah,
they clearly do.
Yeah, I mean, she did well because you can't expect her to stand there and say that what you and I and we all know, that of course you can have a hypothetical situation where inflation is way too high as they claim it is, and it is, and yet you think and your conclusion is that a rate hike today would make financial stability more questionable or in danger. What do you do? But you can't. I mean, Martin Arnold from the FT tried that one, but I think Lagarde did well in answering it. But there is, let me also say, of course, if there were to be a financial crisis, a real one, inflation will not be a problem because you get a recession and then that takes care of all this sort of stuff. But
Erik, but how close are we? So I understand you're not 2008, but that doesn't mean that this isn't something. I mean, looking at First Republic, shares are halted. There's a report from the Journal saying that maybe JP Morgan and Morgan Stanley are in talks to bolster First Republic. It's like any backstop here is in essence being ignored. Just look at what happened with Credit Suisse over the last 24 hours. Erik, what kind of financial tightening are we going to see here? I mean, Morgan Stanley is looking at higher funding costs of operating for banks. Goldman Sachs increased its outlook for a recession. JP Morgan, Michael Feroli talking about how lack of credit growth is going to subtract from U.S. GDP. What do you think?
So I think it's a dangerous thing to say, but I think this is a bit of a storm in a teacup. I think in a month or two this thing is behind us. I don't think we're going to have a great financial crisis. The banking system, both in America, the big banks, and in Europe, the big banks, are all way too solid to see this thing coming about now. And the central banks, as you alluded to with the staff, are well prepared in a way. They kind of know what to do. But I just don't see the underlying imbalances really have the red flags up here.
If that's the case, and she addressed that, she talked about, she said, if the uncertainty reduces and our baseline persists, we still have a lot of ground to cover. The market's pricing in, let's call it circa 25 basis points for that next meeting. Do we get 50? Do we get 50 then? How much further does the ECB have to go? Still lots of ground to cover. What do you think that means?
Yeah, so I don't like. I mean, I have been as a dove all along. I think they have been too worried about inflation and inflation expectations and the wage growth. I think this is a clear case of a cost-push inflation. It takes down real income, and it will take down the growth picture down the line, and it will take care of inflation. So they are actually causing more trouble for real income in real disposable income.
Inflation is projected to rise this year.
Yes, yeah, I see this. I think they are too pessimistic on the slowdown in inflation. There is, of course, something from the profit margins, but the wage growth in Europe is not there. Inflation expectations is well anchored. So I think they are too obsessed with actual inflation today, and that's the one thing that bothered me a little bit with the otherwise clear message of the three pillars of the reaction function. The number two, as I read it, the underlying inflation, and I think, at least I think I heard her say, that's sort of the core inflation and parts of core inflation we see today. But the reaction function should not be about actual inflation. It should be about the outlook, right?
Yep.
So I think a long way to cover, or as they like to say it, really, are we going to have massively real positive interest rates into sort of slow down the economy a lot? How much? I don't know. So I think the base case scenario for the outlook leads them to a more hawkish outlook than I would do. This is an old story.
Yeah, no, Eric, and I know you've been on the more dovish side. So let's say then that the ECB continues on their trajectory and they feel like they can use levers on their balance sheet to help banks if there are liquidity issues, and they keep going. What's the next thing that breaks?
Oh, it's the, I mean, hopefully not in the financial system, but I think it is. So let me start with that. There's a small risk, I think, or some risk, that smaller banks could start to see a little bit more trouble, and that will then cause them to go a little bit slower. But I think otherwise what you will see will break is the growth rates and then the labor markets, and then they will start to slow down. So I think my hope is now that before it sounded like they were thinking about 50 again next time. I doubt it. I think so in May, maybe they only go 25, I hope. If nothing, hopefully nothing, in my opinion. Yep. But it is, but I think certainly they're a little bit more nervous, because the important thing is the reaction, the transmission mechanisms you referred to, the third pillar of their thing. There's no question in my mind that the banking system is now more nervous and more cautious with the lending than before. So the transmission is slowed down. That calls for a lower terminal rate, right?
Eric, it's been great to see you today. Thank you for stopping by here at Bloomberg, listening to the press conference, and then giving us instant analysis.
Thanks a lot.
It's great to have you here. Thank you very much indeed. Eric Nielsen, UniCredit Group Chief Economist. Alex, while we've been speaking with Eric, that Wall Street Journal headline it is certainly having a meaningful impact on the KBW Bank Index. We are seeing it spiking significantly higher on the back of the potential support.
Yeah, you're also seeing a NASDAQ 100 up by over 1%, so it actually is moving the whole market. Volatility, though, circuit breakers have been paused here. Let's get more on all of this market reaction today. Mira Pandit, global market strategist at JP Morgan Asset Management, joins me now. How can I interpret market sentiment right now? And I'm talking about how it doesn't seem that any backstops that have been announced by central banks, by governments, have helped the sentiment. Then you get this headline from the Journal, and all of a sudden you have a boost in equities. And I'm just wondering, how do you understand market sentiment and the fragility right now?
The equity market in the U.S. has been remarkably resilient, and unfortunately, I think potentially for the wrong reasons, because we did see that the Fed, the FDIC, the Treasury did step in over the weekend, and I think that was categorically a good thing when we think about the U.S. banking system. But again, it's a good thing for the wrong reasons. If we think about the fact that equity markets have been resilient in the face of lower expectations of what the Fed potentially does and a lower potential terminal rate, that would be a great thing if we had seen remarkable, immense progress from CPI, from jobs, but we saw middling progress, still some, but that wasn't really the big driver there. So the fact that the market is reacting, relatively positively to the fact that we are applying some guardrails here shouldn't necessarily be a catalyst for markets to move much higher. I don't think we need to see equities pull back massively, but I think that there is still some vulnerability here to a correction, because we don't know how this all continues to evolve.
Mira, are we accelerating now at a quicker pace towards a hard landing, towards a recession, do you think, as a result of what is happening?
Our recession view has overall been consistent in that we have felt that while we're continuing to see disinflation, even though the progress is slow, we are also likely headed towards a mild recession. When you compound this with some of the banking failures and some of the financial stability fears, of course, that ups that even a little bit further, because if we see slowing loan growth, that's going to have an implication on the consumer, on businesses. So I would say that this does add to it, but it doesn't necessarily change the fact that we have been forecasting that we will likely end the year in a mild U.S. economic recession.
So where then do you wind up hiding out? Normally we'd look at the bond market, right? But it's really hard to make that case when you've seen such massive volatility. Like, I appreciate that the 2-year yield is now up by 15 basis points, but can you chase the rally that we've seen in the last few days?
Look, when it comes to investing in this type of environment, for the entirety of the last year, we have been moving up in quality. We have been really underwriting all of our positions in our portfolios, and I think we need to continue to do that. We can get maybe a little bit more defensive on the equity side here. We have liked healthcare for a while, which tends to be defensive in nature, maybe adding tactically a little bit to some of the other defensive areas. We continue to like areas like energy. Look, U.S. valuations are roughly in line with their long-term averages. Maybe that doesn't mean this is the place to add, but when we think about our longer-term equity prospects, we still are looking at mid to high single-digit returns over a multi-year time horizon. And there has been a lot of volatility in the bond market, of course, but those higher quality bonds are what are going to protect us if we do potentially head into recession.
Is the banking sector defensive, do you think, at the moment, Mira?
This is not the time to buy the dips in the banking sector or the financial sector writ large just because valuations have reset. If you are dipping a toe into areas of financials because they have pulled back, you better really know what you're doing. The expertise, the active and thoughtful selection is very important here because there's a lot we don't know and there's a lot of uncertainty ahead. So we do want to be mindful of that. If we are in that area, potentially in the U.S. large cap, it tends to be a bit higher quality. But, I would certainly say that there are other areas to consider outside of financials and banking, just given where we are at this very moment.
I guess the final question is, as we go into next week and the Fed, what do you think the Fed's going to do? After Christine Lagarde came out with 50, it does seem to be that it's on the markets to show support. Like it's going to be on what the markets do in the financial instability question that this is all going to rest. What do you do into that meeting?
The Fed is taking it day by day, and that is really important considering the moves that we have seen over the last couple of days, each in reaction to each other and some of the developments that are happening. I think the Fed would like to go another 25 basis points in terms of just really shoring up the inflation picture, but equally I think if they paused in light of the developments that we have seen, that would potentially be a prudent move. We have to remember that yes, there is still a wage issue, yes, there is still an inflation issue right now, but these are deeply lagging indicators. So what we want to be prepared for is what is to come. And I think that when something starts to break, the Fed ought to consider applying the brakes when it comes to monetary policy because they've come a long way.
Right. What does that pause look like? Hey, Mira, thanks a lot. Thanks for being patient with us as well. Mira Pandit, Global Market Strategist at JP Morgan Asset Management. Guy?
Let's talk about where we are with the markets right now. I'm going to give you the European perspective post the Christine Lagarde press conference. The euro's just beginning to gain a little bit of traction. It's interesting. The headline out of the States regarding First Republic may be actually moving markets on both sides of the Atlantic at the moment. We need to be careful in terms of how we're phrasing this. Alison Williams, just speaking on Bloomberg Radio, Bloomberg Intelligence, talking about the fact that the word acquisition is not currently being used, but it's certainly positive. It's lifting the Euro Stoxx 600. We're back at 440. Credit Suisse is also getting a little bit of a lift. We saw a big move first thing, Alex. That move then faded. We're getting a little bit of traction back into that move as well. Clearly, we are not fully and completely unwinding those losses of the last couple of days.
No, definitely not. So, Guy, here you mentioned that headline, Morgan Stanley, JP Morgan looking at parts of First Republic to help shore up the bank. So let's just take in what's happening with the markets here. The S&P flipping into positive territory, up 0.6%. NASDAQ 100, the upper performer, up over 1%. The regional banking index now relatively flat. First Republic was halted. Now it started trading again. That stock, though just down 23%. I think it's probably halted again. Westpac up here there, down 15%. I do want to draw your attention, though, to what's happening with the front end of the curve. It was pretty muted trading all throughout the morning, and just in the last hour, we really picked up steam here. A strong move in the bond market, up by about 14 basis points as we kind of take on that flattener again for the 2-10 spread, Guy.
Yeah, let's talk more about what has been happening over here in Europe. It does seem to have in some ways been setting the pace over the last couple of days with this First Republic story, maybe sort of taking the limelight now. We're through Christine Lagarde. She was speaking a few minutes ago, this after the ECB delivered that 50 basis point hike. She also addressed the issue that we're all focusing so much on right now. What are the issues currently facing Europe's banking system?
We are monitoring current market tensions closely and stand ready to respond as necessary to preserve price stability and financial stability in the euro area. The euro area banking sector is resilient with strong capital and liquidity positions. In any case, our policy toolkit is fully equipped to provide liquidity support to the euro area financial system if needed, and to preserve the smooth transmission of monetary policy.
The interaction of price stability and financial stability absolutely critical at the moment. In many ways, the ECB is looking elsewhere for that financial instability at the moment, over to Switzerland, over to the United States. But we've got it covered here on this program. On the price stability side, Maria Tadeo. On the financial instability side, Oliver Crook joining us from Switzerland to take a look at what is happening with Credit Suisse today. Maria, I'm going to start with you. What impact do we think can we deduce from the press conference we just listened to? What impact did the Credit Suisse problems, the issues with SVB and the issues with First Republic have on the decisions that were made today by the ECB?
Well, look, to me, I would say three things. First of all, you did not really hear a lot about it up until maybe 15 minutes into that press conference where she specifically began to refer to those tensions, although she made it clear the European Central Bank had been monitoring both closely. She also stressed she does not see a trade-off between price stability, by the way, repeated and insisting, no, the kind of determination, really the stamina to combat high inflation remains there, but obviously the very aggressive forward guidance going forward that is essentially gone after this meeting because of that volatility that you alluded to. But when you look at that decision, I guess it just that's the answer for you. Ultimately, there was this real tug of war between do you focus on just the data, ignore the volatility, or actually capture the moment, especially yesterday, given the fears and the exposure that some of the European banks have to Credit Suisse. And it was the data that really won this. However, there were a number of caveats too on that front where she said, when you look at 2008, I was there, I have a vivid recollection, European banks are much, much stronger now. There was also a very subtle criticism from Luis de Guindos, the VP, to perhaps the U.S. regulator, saying a situation like the one in the Silicon Valley Bank would not happen in Europe. And then, of course, ultimately, it was that sentence that summed up the whole press conference. We don't see a trade-off between the two. Both can be managed at the same time. Obviously, a lot of that will depend on whether the market or not believes they can do it at the same time simultaneously.
Yeah, those are pretty strong words and a pretty bold statement considering we don't know how this is going to shake out. Ollie, that brings me to you. It doesn't feel like the backstops are working when it comes to how things are trading. Why?
So you had this press conference, and just when those lines were being uttered, you ended up hitting a session low on Credit Suisse. Of course, I was watching that press conference with the share price up the whole time because you saw that sort of bazooka from the SMB overnight where you had 50 billion